Time now for the word on Wall Street. Top investors watching your money. Joining me now is Claro Advisors Managing Principal and Founder Ryan Belanger. Also with me, Mark Tepper. Ryan, I do want to start with you on the sell-off that we're watching this morning. This is the first full trading week of August. We hope this isn't some ominous sign. Dow is down 782. The NASDAQ is down 803. That is more than 4.25% of a sell-off. The NASDAQ entering correction territory on Friday on the heels of that jobs report. Your reaction?
Morning. I say buckle up, folks. I think this is the sentiment shift that we've been waiting for. There's definitely been froth in the market for some time. Earnings actually haven't been terrible, still up 12% for the quarter. So it's not so much that. It's just this employment number that came out Friday that really shocked people. Seems to me people were really singularly focused on the path of inflation, which has been good, but there's a dual mandate. And we've been very concerned that people would be not focused on the labor market as much as they should be. So we're a little bit concerned here. But this, if this is the start of the recession, these things don't have to be terrible. So I wouldn't want people to panic. These are part of the economic cycle, but it is definitely worrisome, and investors are definitely taking notice of these large swings.
I'm glad you said that because, look, Mark, 800 points to the downside isn't 800 points to the downside a decade ago.
Right.
Or, these numbers don't look good. Certainly we have concerns, but at the same time, what goes up must come down, and some say that corrections are healthy for the market. I think the bigger concern really is the economy.
Yeah,
right now.
Yeah, and obviously if we enter a recession, it's not going to just be a correction. We'll see a full-blown bear market, which would be painful for a lot of people. But we were talking earlier today. We've been through this before. 1, 2, 3, 4% sell-off really doesn't cause most investors to change their strategy unless you're making knee-jerk reactions. But when you kind of just look at everything that's happening right now, to your point, I mean, a lot of these tech stocks got to the point where they were overextended. And I've been very critical of Apple over the course of the last few months. And we just found out that Warren Buffett has shed roughly half of his Apple holdings over the course of, I don't know, maybe the last quarter or so. But you look at a company like Apple, which isn't growing as fast as they used to, trading at a higher multiple than they've really ever traded at. And at some point, the results have to be there. And when you look at just AI specifically, we don't really see the results yet, right? The ROI, the return on investment, is not there just yet, and investors are becoming a little impatient. And then you go to the Friday jobs report. I will mention one more thing. Yeah, that was a terrible jobs report. That, to me, signals recession, but it is one data point, Cheryl. Like, you could get a better jobs report next month, post-hurricane. So we'll see what happens there. Again, I think it's best that people don't make knee-jerk reactions.
Ryan, do you agree with that?
Yeah, generally I do. I think it's, but also let's just zoom this out a little bit. What's a 25 basis point cut going to do for most folks in this country that have seen their grocery prices go up 30 or 40%? I mean, that's not going to make a difference for them. These are compounded problems over the last few years that need to be sorted out. And sometimes this is the pain that you have to go through, unfortunately. You don't wish this on anybody to lose their job. But actually, this number was more people looking for jobs. The labor participation rate was going up. So who are these people? Are these immigrants looking for jobs? Are they retirees that have said, look, I can't afford groceries anymore. I've burnt my savings. I've maxed my credit card. I got to go back to work. We got to figure out who these people are. And as Mark said, we're not going to know this number. The next labor number doesn't come out until September 6th after Labor Day. So everyone's looking to next week's rate, the CPI number next week. But who really cares at this point? We got to worry about the labor market. So we have another month to go. And so we'll see what happens. But I think there's a more structural issue here for the economy.
Well, Mark, I will say that this certainly does bode well for those on Friday that began to make the bet that we're going to see a half a point cut at the September meeting for the Fed. But you also have pointed out repeatedly that as far as Americans go, the personal savings rate has been going down.
Yeah.
You and I have talked about that on the air, actually. So it really does come down to the health of the consumer, which is 2/3 of the economy.
Yeah, I mean, consumers are saving less money. They are reaching for their credit cards more often. They are racking up buy now, pay later debt. It's estimated that there's like $700 billion in buy now, pay later debt. And don't look now, but Affirm, one of the biggest buy now, pay later companies, is one of the worst performers in the pre-market today. But when we talk about the savings rate, I also want to talk about the savings interest rate. So one of the things that's actually been helpful to the economy over the course of the last year and a half is the fact that people are earning 4 or 5% on their savings accounts, on their money markets, because not everybody is an investor. Some people don't understand stocks, they don't understand mutual funds, ETFs, and they just want to go to their bank and earn 4 or 5%. Well, right now, the Fed fund futures are pricing in 6 rate cuts by the end of January. Not the end of next year, the end of January. If that happens, you're going to see a lot of these savers, they're going to be hurt because they're not going to be earning enough. And then where do they reallocate that money?
And Ryan, all of this talk about markets and a possible recession as we're 3 months away from the election.
Yeah, I mean, there's volatility coming for sure. I mean, over long periods of time, elections don't make a big impact on these markets, but I think the data that we're looking at definitely is the health of the consumer. Certainly, certain industries will be helped by rate cuts or hurt if they're prolonged. But I just think, generally speaking, it's not a great situation out there. And as Mark said, not everybody owns stocks. I mean, these rate cuts are great for people like us that own portfolios of stocks and our clients that do, but a lot of people don't. They just want to be able to afford to live and not have to pick up that second job. And I think these are some of the policy situations that we need to start addressing in this country.